Hey folks, it's Dave Burrows, Chief Strategist at Barometer Capital Management. Thanks so much for joining in today. I'm going to try and blast through things fairly quickly today. I'm on the road, but I thought it was an important day to do an update. We got a really big week this week for data. Certainly the market has been anticipating the release of the CPI data that came this morning. We'll have more on that later. We have the Fed decision tomorrow, and more importantly, some commentary that will come from Chair Powell on future path for rates and expectations. He has had a habit of having a particularly hawkish stance in the press conferences over the last few press conferences. So market decidedly kind of on tenterhooks to see how his demeanor is tomorrow. But we did get a little bit of respite today from CPI data. What I wanted to do today is just talk a little bit about the setup coming in, how the market handled the data, because I do believe that markets will tend to handle news in the way they are predisposed coming into the news. It's more important to understand the reaction to the news than the news itself. And so this is something I want to key on today. So just quickly from the top, we continue to believe we're in a structural bull market that started in 2013, much like the bull market that ran between 1981 and 2000. That would put us partway through a typical structural bull market, which tend to last 14, 15 years. And so long as we remain above this green 200-week moving average, that has tended to be the lower bound in a structural bull market, much as it was through the 80s and 90s. And so far, so good. We did hold that line in October when we tested it. We've had a couple of up months since. And in the month of December, we did start with a weak start to the month. So we got to keep that in mind. Seasonally, December tends to be a pretty good month by the end. From a interest rates perspective, we believe we saw structural low in rates in 2020, and that we broke the downtrend that was in place all the while from 1981 through 2020. That's a 40-year bull market in bonds, and lots of consensus thinking was built during that period as to how to be invested, how to be positioned. But clearly, we are in a different environment today than we were during that period. I like to use the period between 1951 and 1966 as a better comparison to the environment we're in today. It was a reflationary environment. You came out of the war. There was financial repression due to the exorbitantly high debt that sovereign countries were carrying on their balance sheets. And in their attempt to manage that debt, we're able to slowly reflate the economy and reflate asset prices to offset the impact of the debt. In that period, savings were basically stolen from savers, people that bought bonds as a safe place to put their money, because the net return on bonds over the period between 1951 and 66 was 0% per year, 1.6% inflation, and about 1.6% interest on bonds, no net return. So it's been a very tough year for fixed income investors this year, the worst one on record. We've talked a lot about that. We had a big sharp rise in 10-year yield starting in the middle of 2020. We broke the downtrend in place since 1981. And we pulled back a little bit off those high yields. I think the high chart point was 4.3%. We're sitting more like 3.5% today. And certainly that has provided some respite for equity markets. We've had relative outperformance in commodities so far since midway through 2020. And we think that that's probably still relatively early days. And like any other structural bull market, you're going to have fits and starts. We had a great run month by month, starting back in mid of 2020. We certainly consolidated a little bit, but important to note that commodity prices held their strength through April of this year, while the stock market rolled over in December. So good relative performance, and certainly have been very stable over the last 3 months, despite the fact that there have been major concerns about some kind of a hard landing in the economy. It does point to the fact that there are some structural deficits, not in every commodity, but in many commodities, and that commodity producers, may have a more interesting future than they have had a past since 2008. Interestingly, this month, gold behaving particularly well. We put this chart up before. What I'm highlighting here is a price pattern that we would call a cup with handle. So it's a consolidation that happened in this case from 2010 through 2020, a breakout to new highs, and then a consolidation for a series of months. We pulled back to the long-term average, and 1.5 months ago broke that downtrend, started a new leg up. And if in fact we can follow through here, this is a very, very powerful bullish price pattern. It would signal that we likely would see an initial move toward $3,000. And given the state that the world is in, the debt that sovereign countries hold, there is a tendency by governments to try and inflate away their debt. And gold is doing a very good job of maintaining its relative value versus inflation. So more to come on that later. Real estate continues to underperform. This is the Real Estate Developers Index. It's been underperforming since 2020, and that continues. Let's talk about the dollar for a moment. This has been an important linchpin, probably one of the most important moving parts in the world's macro machine. We saw a very sharp run up in the US dollar versus the euro, the pound, and the Japanese yen, among others, but in particular, those three. And we have seen a sharp pullback, about 10% coming into the CPI data today. We talked last week about the fact that we had broken the uptrend that had been in place since 2020. And again, another moving part that was starting to take pressure off risk assets. If you could have long-term rates start to back off, that signaled that the Fed is doing its job. You see the US dollar start to back off, the belief that rates in the US need to be markedly higher than in other countries, helps the currency to back off. And with those two pressure valves releasing, it has been more supportive for risk assets, commodities, and short duration, economically sensitive groups. So, of course, the major concern in the Fed cycle has been that the Fed would tighten enough to cause an accident. And we've seen that many times over the last 40 years, while the Fed was raising rates against a longer term downtrend in rates. But as we talked about last week, in a reflationary cycle, often economies are strong enough to withstand rate cycles, bear relatively mild recessions, and bear markets associated with an ordinary recession tend to be limited to 17 to 25%. At the worst point in October, we saw 24.7%. Now, some people take the approach, they're going to have a little bit of money everywhere in every asset class, get diversification, get a free lunch from diversification, and that does make sense. We think, however, we can target assets that have a strong structural backdrop and have a willingness to avoid other assets and be more tactical. We think our job is to identify those groups or areas in our investable universe that have a tailwind and focus in those areas. We don't have to be everywhere. We watch every week for signs that something may be changing, new leadership to emerge or old leadership to recede, and be prepared to make adjustments. In the absence of leadership, have a willingness to sit in cash. It's very easy to build a diversified ETF portfolio and be passive. We think that will penalize investors and have them live with underperformance for extended period of time when certain asset classes go into or out of favor. So this is most definitely a tactical approach. Last week, we talked about the fact that we had been seeing improving breadth data overall, but in the short run, we saw some of our short-term indicators turn down. Importantly, while December started out to be the worst December in several years, the breadth data for Canada, for the US, and globally maintained its positive stance so far. So coming into these uncertainties this week, the CPI data and the Fed decision, certainly breadth was challenged, but our long-term models that track the percent of stocks within a specific universe that are in long-term uptrends were able to maintain a positive stance. That tells me the market is very resilient despite the fact that we see extreme negative sentiment. We talked last week about the lowest number of bulls going back to the early 1990s and the most bears in the market since the financial crisis in 2008-9. We talked about the fact that hedge funds have taken their exposure down to extreme low levels. And this month, put call data highlights how extreme the hedging and put buying has been, fears against some kind of a collapse. This is the largest monthly put buying on record by a wide margin. Now, it's been my experience when something is anticipated and is consensus, it is unlikely to occur. Today, coming into the CPI data, lots of crash talkers on Twitter, lots of commentators looking for extreme sell-off. And we got sort of the opposite. We got a more dovish number and we got better behavior out of the market. Let's look at the data. This is US CPI for urban consumers, less food and energy. You can see over the last 3 months, we've started to see this number come down. Let's look at the year over year top line contribution to CPI. You can see we started to move lower in June overall, largely being driven by energy. And we've certainly had some weakness in commodities, or some pressure come off from commodities. The one area that really has been persistent is services. And it's important to understand that services largely encompasses rents. So if we look at the month over month expectation was that CPI would come in at up 0.3. It came out up 0.1, a significant undershoot. And that's relevant because it's the most recent month and the most important contributor that we need to watch. If we break it out another way, we look at core goods in October and November, the inflation on core goods coming down, furniture, autos, etc. If we look at services ex shelter, it's come down sharply over the last 2 months. The one that is more persistent and the one the Fed is concerned about is shelter. But in fact, shelter came down this month as well. If we were to limit CPI increases over the next few months to 0.1%, as we did this month, you can see that in the year over year numbers, by April, we'd be at 3.5%, and by May, we'd be at 2.4%. This data today helps the Fed to move along in its process toward pausing in their rate increases. And I would expect tomorrow in the press conference for Powell to start to take a victory lap, and markets are anticipating this. When we look at the US dollar, which would be a key barometer for what investors are expecting the Fed to do, it was down sharply today. We talked over the last few weeks, we had broken the 200-day moving average on the US dollar. We had a rally attempt leading up to a week ago underneath the 200-day moving average, and that has failed over the last couple of days. That is very helpful for risk assets, and it tells you what a broader cross-set of investors are starting to believe. Let's look at the S&P 500 under a microscope. We certainly rallied off the October lows, similar to the rally we had in June, up to the 200-day moving average, which is declining. This is where we should have expected to see some resistance, and resistance we got. At the end of last week, lots of people expecting a significant break early in the week. Today, I think we did not get that. The market rallied sharply on the open. That might reflect the fact that there are a ton of shorts in the market. There are a lot of people who have purchased puts, and definitely we're on the wrong side of things. When the S&P opened, it was up 3.5%, and the NASDAQ was up 4%. And while it certainly came back, we stayed above that 200-day moving average. And I think that that's key. Now let's take a look under the covers, because I think there's more relevant data when we take away the impact of the largest market caps. If we look at the RSP ETF, which is the 500 companies in the S&P equally weighted, in other words, taking out the impact of Apple and Google and Tesla and Netflix, You can see we already had traded above the 200-day moving average. We pulled back from above it and tested it, held, and have rallied back above. So this is a more attractive technical setup. It speaks to the average stock as opposed to just those large tech companies that so many people own and care about. The broader market is healthier. When we look at the NASDAQ, with the equal weight S&P versus the S&P market cap weighted, you can see that the relative performance of the average stock has been outperforming the S&P since the early part of 2022, and that has not changed. Now let's look at the NASDAQ. NASDAQ 100, QQQ, relative underperformance since November, and that continues to today. Trading worse than 73% of companies in the S&P 500 so far on the year, trading below the 50-day moving average and trading below the 200-day moving average. Both of them are falling. Both of them are going to cause some resistance. Now, interesting enough, so far this year, there is $25 billion of net inflows into the QQQ. There's $120 billion of net inflows into the long end of the U.S. bond market, the TLT. Both of them were beneficiaries of falling rates for 40 years. Both of them became consensus investments for a broad cross-section of investors. Neither of them are working. People continue to look over their shoulder at what worked in the last cycle. And very clearly, we have different leadership currently. The QQQ, relative to the equal weight S&P 500, has been in decline all year. Nothing has changed. So while many of those companies opened strong this morning on short covering, a lot of the strength dissipated over the course of the day. There is no new leadership in this group. Let's look at volatility. The spike in volatility in 2009 to just about 90. The spike in volatility in 2011. The spike in volatility in 2015, the beginning of the slowdown in China. The spike in volatility in the Fed taper tantrum in December 2018, and the spike in volatility in the COVID sell-off starting in 2020. All of those marked points of extreme pressure on stocks. Volatility today sitting at 22, really in line with the long-term moving average. This is not speaking to extreme caution. When we look at the spreads for BBB bonds or for investment grade, both of them are somewhat elevated, but have been coming back in over the last few weeks, meaning that investors are demanding less premium to buy corporate debt, and certainly doesn't challenge anywhere near what was happening in the COVID situation. Neither of these numbers are pointing to a near-term financial crisis. So breadth is showing resiliency in the market. The average stock is showing resiliency in the market. Volatility remains muted. Credit spreads relatively benign. All of them against the backdrop of the most bearish investor sentiment I can remember in my career. Let's talk market leadership. Industrials have been leading the way since the early part of 2020. They certainly held the same levels in both of the lows in the S&P earlier this year. We've made relative strength new highs over the last 2 weeks, and this is made up of the rails, the steel companies, and defense companies, and the equipment manufacturers like Cummins and Caterpillar. Pretty economically sensitive groups, pretty resilient in the face of all of these concerns. Let's talk financials, capital markets, IAI, ETF, made up of companies like Schwab, JP Morgan, Morgan Stanley, and Goldman Sachs. Relative strength has been rising since March of this year. We made a higher relative strength low in October when the market retested the lows from June. This group held a substantially higher low. We're trading above all the long-term moving averages and has been very resilient, again, in the face of concerns around a hard landing. Let's talk about energy. While certainly energy has pulled back over the last few weeks, had a good day today, standing above all of the major moving averages. It may be just consolidating, it may be something different, but in the near term, energy versus the S&P has a very clear uptrend in place. And we've tested that this week and so far successfully holding it. Let's talk about materials. Here we're talking about steel, we're talking about coal, we're talking about chemicals, we're talking about gold, we're talking about the things that we build things out of. Things you would expect to be weak if we had a hard landing in the economy. Relative strength rising since March of 2020. Again, groups that people don't think about being invested in a disinflationary world, but things that you want to own if we are going to be in a reflationary world. Relative strength continuing to be strong. Included in this group, the miners. We've talked about the fact that they come out of a major multi-year consolidation going back to 2014. We've consolidated and we're moving higher. I think very constructive going forward. Steel, the same picture. Steel making the same kind of relative turn that it made in the early 2000s when tech started to underperform and the industrial economy started to perform better. Again, we broke out on a relative basis above the relative highs from 2016 over the past couple of months. Again, this group looks like it's set up well. We talked about gold earlier on. So these are all pretty economically sensitive groups. On the other end of the barbell, we've been focused in things that are a little more defensive that would protect us in the event that the economy starts to slow more sharply. Relative outperformance in healthcare, XLV, and you can break this into groups like pharmaceuticals and biotech. Consumer staples, in fact, made a new relative high this week. And when this takes place, it tells us that investors are interested in having the dividends associated, the dividend growth associated, and the insulation from economic risk. So on one side, we have dividend and dividend growth. That's in the defensive camp. On the other side, we have short duration assets that have an ability to raise price, largely because there are structural deficits in the market. And infrastructure fits into that same camp from a dividend perspective. Let's see if there's been any change in the relative weak groups. IGM, which is made up largely of large cap tech, continued downtrend in relative strength. We have continued downtrend in the unprofitable tech. Again, massive inflows into the ARKK ETF, despite the fact that it's down just about 80% on the year. And communications, which would include Netflix and Google, along with a number of the telecom operators, again, continuing to have very, very weak relative strength. So not a lot is changing. Growth leadership is not reemerging. Value continues to be very good. What is changing is we're seeing some improvement in various areas of the consumer, and most surprisingly, in the home construction market. This is the ITB ETF. It's made up of home builders like Lennar, but it's also made up of the construction materials companies. We saw a relative strength low in March at the beginning of a discussion of Fed rate hikes. We saw a higher relative low in June when the market made its low. We made a higher relative low in October when the S&P went back and retested the lows. And we've seen improving relative strength since then. We're trading above the 9-day, the 21-day, the 50-day, and the 200-day moving average. This is most unusual if we think we're going into a hard landing in the economy. So when I look at the point and figure chart, and this is one of the things that really stands out to me, not only are we seeing higher highs and higher lows in the ITB, but we've also exceeded the highs from earlier in the year. This is a nice reversal. And from a long-term perspective, the ITB looks a lot like a lot of the commodity charts. This is the ITB chart going back to 2007 at the beginning of the financial crisis. The reason that we want to come out of groups that go through major declines like this is it can take years and years to get back to break even. We saw that in technology after the 2001 through 3 tech wreck. It took to 2016 for the to get back and make new highs. And this is the home builders from 2007 through 2020. That's 16 years. We broke out and pulled back to the long-term rising moving average, and we've hooked higher. To me, this looks like we started a new bull market in this group. So this is a group that we're looking to add to. We also saw continued strength in value versus growth, no change here. And in the resource area, we have seen a relative improvement of gold producers versus energy producers. Gold relative strength had been weak. Over the last 5 weeks, we started to relatively outperform here. We'll see whether that turns into something. But certainly, given the way that gold is acting and the actual gold producer performing, this is a group we want to have some exposure to. So there are things to do in this market. There is consensus in the where people are putting their money and the things that they care to read about, while there is non-consensus in some of the groups that are performing the best. We put our money where our mouth is from a positioning standpoint. Industrials are now our largest weight at 16%. That's just about twice market weight. Finance is a small overweight, down a little bit over the last few weeks. Materials has grown in the last 2 months from 3% to 12% of our overall portfolio. Healthcare is maintained roughly around 9%, a slight underweight. Energy did come down because we have to respect our stop losses, and some of the positions got stopped out. It may well be that they're going to have to regroup. We'll watch for that. Our bond positions relatively the same. This largely are the bond positions that we hold in our balanced portfolio, where we have to hold some bonds, and they're short-term bonds by nature. Consumer discretionary is an underweight. Consumer staples in line. Communication services underweight. Technology underweight. Utilities underweight. And real estate underweight. Outside of the US, Japan continues to perform well. This is probably the least consensus position that we own. This is an index that underperformed for 40 years. But they are, for the first time, seeing early signs of inflation, which they've been trying to generate now for about 30 years. This is certainly one to watch. Also, we own India. We own a new position in Europe. We're broad-based EZU ETF. As the euro has been strengthening, some of the equities that are more value-oriented in Europe are starting to outperform. We'll see if that develops into something more. And I get it. I understand why people are so negative. It's been a very difficult year across virtually every asset class. The really only asset class positive on the year is commodities, and it's a very small sector that people don't seem to care about. They will, but they don't care about it yet. We recognize that when you have a really weak period, first 9 months of the year to the end of September, sentiment's going to be negative. But as we've tried to point out, if we take every occurrence where there was a very weak 9 months to start, if you move forward 1 year, 3 years, 5 years, or 10 years, the returns tend to be very, very good. So it's easy to get caught up in negative rhetoric. This is a data point I put up on Twitter this week. This is from a gentleman named Milton Berg. It's not something that we trade on, but I think that he's one of the smartest quantitative analysts on the street. He has just about 20,000 indicators that he follows. And I'll just quote him. This is an indicator they call the Copic Guide. It's a weighted total of the 11 and 14-month change in momentum in the Dow Jones Industrial Average. In other words, a decline and the reversal in momentum. You can see that the signal has happened only a few times going back to 1955. There have been 1958. When tracking the signal against the Dow, one notable failure was the signal on January 31st of 2002. So right here. In that case, there was only a 7% gain over the next 32 days, but then there was further weakness into the lows 174 days later. Having said that, the forward-looking returns on each of these signals: 47%, 20.43, 50.61, 13.77, 24.36, 44%, 7%, 42.8, 41.97, 48.89, and this one we will see. Now look, we watch every day of every week for signs that our breadth models are reversing down and that the market is losing its footing. We are very willing to play defense, and it will be no different if, when the Fed reports their decision tomorrow, markets react poorly and reverse some of our models. But as we sit today, we do believe we're in a structural bull market in equities. We believe we are in a structural bull market in commodities. We think that we are in a structural bear market in bonds and a structural bear market in real estate. You have to pick your spots. The last thing I'll leave you with: we are now in the 2 strongest months of the year for inflows into equities. Doesn't mean it will appear, but it means there's a tendency. December tends to be a strong month, and January also tends to be a strong month. It shouldn't be a surprise when the equity inflows tend to come in those months. So should things get more difficult, we'll certainly be willing to play defense. But for now, market seems to be set up well to absorb bad news, and we'll look for what comes tomorrow out of the Fed. If something needs to be updated between now and the beginning of next week, we will send something out. But at this point today, I can see that bullish percent for the NYSE was up about 3%. In other words, a net 3% of companies in the market gave new buy signals. That takes us away from any near-term reversal down in our bullish percent models. We'll see what comes. It's a step-by-step process. So with that, I'm going to take a look and see if we've got any questions here. I don't have a moderator today. Just quickly. What is our take on concerns some analysts have that markets have not priced in the potential reduction in S&P earnings per share in 2023, when analysts are still projecting 10% growth? I recognize that there are a lot of people that are concerned from an earnings perspective. We've seen a lot of earnings revisions lower recently over the last few weeks. Certainly, those are in the market's price. What I don't think is probably in the market is if there was a severe hit to earnings. In other words, some kind of a crisis. We've talked before about the fact that in a structural bull market, a typical recession would trigger a 17 to 25% bear market in stocks. And that essentially is a consolidation leading up to the next major run. When you've had a 45 or 50% bear market, it tends to be made up of a recession that goes seriously wrong and then turns into a financial crisis. The first leg down is to discount a recession. The second one is to discount some kind of major dislocation. So, for instance, the housing collapse in 2008-9 and the financial crisis that ensued. The financial crisis was driven by the fact that banks had 40 times leverage on their balance sheets, as opposed to today, 12 times. So it's a very different picture. In 1929, of course, you were headed into a depression. 1973-74, you were headed into a massive inflation problem and an oil embargo. So as we sit today, I don't see evidence that we are headed to some kind of very hard landing. And I refer back to the comments that we made last week. If we are in a reflationary environment, the economy likely is stronger underneath the surface than people are willing to give it credit for, because they're used to living in a disinflationary world. Next question. In my opinion, what is driving the ultra bearish sentiment? Look, I think this is psychology. There are a lot of people who got caught in the financial crisis of 2008. If I were to just quickly scroll back and pull up that picture. Look, this kind of bear market is one people never forget. And it's forefront in people's minds until there's a new generation that never went through it. So in 1929, we had this terrible financial collapse. And you know that our grandparents or my grandparents were talking about it, 40 years later. But now then they are all gone. Eventually, you had another one in 1973, 74. Again, a terrible bear market of 50%. And for the next 30 years, people looked for inflation to come back. And it was just not that world. You were in a disinflationary world from 1981 through 2000. And when we look at the period of 2000 through 2013, you had a tech wreck, but you really had the problem in the financial crisis. All of those investors are absolutely determined never to go through that experience again. Every day on Twitter, I run across somebody who's doing an overlay chart of today's market versus the market in 2008 and how this is about where the market is going to go off a cliff. And I'm not saying that that's impossible, but I'm saying there are things that would probably have to happen between now and then to put the market in that situation. We don't have blind allegiance to growth stocks today or housing stocks or the banks like we did in 2008. You have healthy skepticism in the market. We've had a correction going on in tech stocks, the unprofitable ones, since February of 2021. So that's coming up on 2 years. So if people have been concerned about this Fed cycle, they've had lots of time to reposition. They've had lots of time to take money out of the market. And we can see that they've done that. So when you tend to have a crash, it's because people are so badly offside, they absolutely panic out of the market. So I don't see those conditions today, but it's conditions we watch for at all times. The first thing that would have to happen is for our breadth models to turn down. There's no bear market ever happened while breadth models were showing expansion. So this is a step-by-step process. That's why we do these webcasts every week. Hopefully they're useful. But certainly I appreciate everybody tuning in. I'm traveling this week, which is why I don't have the camera on. And why I planned on it being a little bit shorter, but it turns out it's just about the normal length of time. If you got additional questions and would like to have a conversation, certainly don't hesitate to give us a call, send us an email. And if you're not clients, we'd be happy to talk to you because, of course, we're always interested in expanding our business. So thanks so much for tuning in, and we'll talk to you again next week.